Welcome to the pod. I'm Mitch Goldberg, your host. You're watching Be the Boss of Your Money. I am a financial advisor with the wealth management firm Client First Strategy. Stocks tank again. They are stuck between a rock and a hard place, between higher inflation and lower consumer spending. It's just a really bad squeeze on the economy, on the stock market. We'll talk about that. But more importantly, what's next? Is it time to buy? What signals or things should we watch out for? I'm going to share with you three charts that I'm looking at, which basically I think, tells us the whole story of what could be next and what we should be watching out for. So let's roll a quick intro. We'll get into it. If you have any questions, comments, please hit me up in the comments. If you're watching in the replay, same thing, I'll see it. And I love your comments, and it just makes it so much more fun. If you don't mind, give me a thumbs up or a heart or something like that. It shows me who's out there. It's very encouraging to me, and it helps spread the good word to all of your friends and contacts, the good work that we're doing here. This is all educational. We're not taking sides. We're calling balls and strikes and educating you so that you could make the best possible financial decisions for yourself. That's what this is all about. And of course, if you have any questions about using our services, feel free to call. Here's the intro. Here we go. Thanks so much for joining me. So the news that came out today is the University of Michigan Consumer Confidence Surveys came out. Low consumer confidence, inflation expectations are rising, the highest in over a decade. And there is inflation because the Federal Reserve watches a particular number called the PCE number, and that came out higher than expected. So we have inflation, but usually lately when we've had inflation, consumers could just keep spending more, and it didn't really slow the economy down. Not now. The perception is higher inflation. Consumers are pulling back. They're spending on only what they need to, and if they have to pay more for something, they'll skip something else as opposed to just buying it all and grinning and bearing it. So it's the worst of both cases. Consumers dropping their spending, dropping their confidence in the economy. People are getting to the point where they don't want to spend. Airlines, retailers like Walmart, Amazon, automobile companies, they're all telling you things are not looking so good. Even Lululemon was down huge today because of a big earnings miss, and they took down their earnings expectations and revenues. They lowered their guidance for all of 2025 now. So now what do you do with that stock? You're like stuck with it. It's going to take a whole year for things to turn around to see if it's even can turn around. And that just means, like, why bother holding on to it? And that's the situation with a lot of stocks. I was thinking of doing a show on all the big name, well-known stocks that are down by more than 50% from their highs, like Tesla, airline stocks, bunch of industrials. There's a lot. There's a lot of big name stocks. UPS is down by more than half from its multi-year high. Who would ever think you could buy UPS a couple years ago, a blue chip like that, and lose more than half your money as time goes on? But that's exactly what happened. So today the Dow was down over 700 points. S&P was down 2%. I have my numbers here, down 112 points. And the Nasdaq down 2.7%, down almost 500 points. That's a pretty big day, folks. And it's at a time when people started to talk about a recovery, a rebound, and lots of people on TV saying, "Oh yeah, I would buy. I'm buying Microsoft. I'm taking my stand. It is time to buy Meta. It's time to buy this stock and that stock." People taking their stand, and people watch this and listen to them, and then they go down more. I'm going to take you back real quick to the year 2000 when tech stocks started to crumble. It wasn't just tech stocks; it was stocks of all stripes. It turned out tech stocks just started the pummeling. The S&P was still down by more than half. I mean, you hear about the Nasdaq being down 80%, but the S&P 500 was down also. By the way, you can't invest directly into an index, but you could invest into a security that tracks or mimics an index. So, stocks like Lucid and Intel, WorldCom, they kept going down. And every day another analyst would come on TV or somewhere in the press and say, I'm not a media hater. I enjoy my media appearances as well as much as anyone. So not knocking that. But I'm talking about shenanigans that goes on. And you have these people constantly, this is a long time ago, people are constantly saying, they're constantly saying, it's time to buy. I would buy it. It's down X amount, but they have growth in revenues. They're going to do this. They've got this in technology, networking, and internet, and megabits, and eyeballs. These were the big metrics back then. It didn't matter. And as big as the internet got, which is bigger than anyone could have imagined, it didn't matter. The stocks tanked, many disappeared. And now I see lots of analysts come in saying they're just defending stocks like crazy. You should buy Meta here. You should buy this. So I don't want to pick on Meta, but the popular big names are the ones that get talked about the most. And I remember in 2000, every time these analysts would talk, like these stocks would go down and down and down. Every now and then they go back up, and someone would come out and say, "Yeah, they're going up now. They're turning on. It's time to buy." And I think the damage that's been done in the market on a technical level is really too much for a rapid recovery. And I remember in 2000 when the market went down, investors were despondent because it's like, other than a massive NASDAQ tech bubble and a new invention like the internet, what could possibly make this market go up back to those old highs? And you just didn't think it would ever go back up. It took 15 years, by the way, for the NASDAQ to recover. That is a hell of a long time to wait. Intel and Cisco are still lower today than they were 25 years ago. So time does not heal all wounds. And then the crushing Great Recession that began in late 2007 and ran until early 2009, the bear market was a brutal one. And I remember when Lehman Brothers went down and Fannie Mae went down and other, because financials were the big names back then. They were the leaders of the market, Bear Stearns, and people kept saying, you got to buy these stocks. You got to buy them now. They can't go down anymore. They're already down by half. These are cheap. They just kept going lower and lower anyway. And people just defended them. And I don't know, I'm not into defending a stock. If you have to defend a stock that much, why even bother owning it? That's my feeling. And then in the next big bruising bear market came out in the pandemic, but that really was over pretty quickly. It did spark a lot of speculation. We had, meme stocks and work from home stocks and stocks like the DoorDashes and DocuSigns and the Teladocs and the Pelotons of the world. These stocks just took off to great heights. None of them are back to where they were. Airbnb. I'm not saying these aren't good companies and it's really amazing what they've done. But, the valuations of where the stock was just way ahead of what these companies could be expected to produce over the next couple of years. So that is, and people defending these stocks on the way down. So here we are now, and I feel like it's the same situation. Maybe the market will turn back up. I'm just, just a guy right now you're watching in social media or on YouTube, and maybe these will snap back. But we'll see. We'll have to see. So I want to look for some clues, and I want to show you some charts that will give me a heads up or an indication of where things could go, and what we should watch out for as more danger signals. Okay, so I'm going to see if I could switch screens here. All right, that was easy. And let's take a look. First one I want to look at is the 10-year Treasury. All right, the yield right now closed today at 4.25%. It was recently down here at 4.18%. So let me go back. Let me go to a year-to-date move. All right, year-to-date, it was down to 4.18%. We're at 4.25%. You see that in the red over here? That's the level. If the yield falls below that level, that's a test. The market's testing its recent lows that it hit, okay, earlier this month. If we go through those, I think it's fair to say we have more downside. We have not put in the low. So the market right now is going through a test, not just in the bond market. We're looking at the 10-year treasury yield. All right. But if it goes below that level, that means people are really worried about a recession, and it's probably going to continue. The yield goes lower, and it's not a good look for the market. When yields on the 10-year go down very low, it means people are buying more 10-year treasuries. They're looking for safety because they're worried about the economy. Let's take a look at the S&P 500 year-to-date view. All right. The low, here we go, is we'll look at the close, 55.21, 5,500. We went out today at 5,580 versus 5,521. So we are about 1% away from that level. So if the S&P drops another 1%, we break through this level, which hit March 13th, which was the low of this recent bout of selling, which also put the S&P 500 into correction territory. Technically speaking, if we break through that, then none of the damage is repaired in this little peak that we just saw over the last couple of weeks over here on the screen. And that, to me, is another negative sign, and it looks like we're going to test it. And then you take a look at, well, those are the two main charts we want to look at. And then we'll just take a quick look here. This is an IPO today that was priced at 40, and it came and it left at 40. This is CoreWeave, and it was supposed to be this gargantuan, great IPO that people wanted. They couldn't even move the stock. The stock, I think, was priced at 39, not 40. And that's a really bad look for the market, that this supposedly hot IPO just couldn't hold water, and investors just didn't want it. It's a really bad look, really just a lack of confidence in the stock market. So these are the three things that I'm looking at. So if we could see CoreWeave bounce up, maybe that'll give a little bit more oomph to investor sentiment as opposed to consumer sentiment. But these two charts, these are the ones that you have to look at, the one on the S&P 500 and the one on the 10-year yield. If we see those break through the lows that I just showed you, that's probably going to be a bad sign, and probably an indication that it's too soon to average down, too soon to buy the dip, and just buckle up. Because if we make, some newer lows than what we saw, which we're perilously close to, I think that adds a whole other shellacking to the market. And so now, instead of worrying about a 10% correction in the S&P 500, which we just had, now we have to start thinking about another 10% down to get into official bear market territory, which is usually considered a 20% down market from a recent closing high. All right, so that's it for today. We'll see. We'll all scour the news. April 2nd, next week, I think Wednesday, that's called Liberation Day by President Trump, when he really sticks it with the tariffs, and we start collecting tariffs the 3rd. I don't think it's a good look. I don't think it's good for the economy. The European Union is actually a bigger economic bloc than the U.S., and now they have plenty of levers to pull also. So we're going to see how ugly it's going to get. I know the Europeans are trying to make nice now with the administration to see if they can mitigate some of this stuff, to see if cooler heads can prevail. I know Canada is heartbroken. I know Canadians personally, and they are heartbroken that this is happening to them, like our great ally. We will see. It's going to take time for confidence and trust in the United States to be brought back as a trading partner. So I don't think that we bounce back right away regardless, because I think there's been a lot of damage done to markets, to business sentiment, consumer sentiment, as well as investor sentiment. And I think it's going to take a while for these things to work themselves out. We will recover, but I just think this expectation that, we're just going to recover in like 2 weeks and everything is going to go back to former highs and we're going to make new highs and everybody's going to be happy. I think that's not realistic. Anything could happen, and we'll see. Thanks for watching, guys. Have a great weekend. If you need me, hit me up in the comments. If you want to have a conversation with me, let me know, and we'll set up a phone call or a Zoom or something, and we'll take it from there. Thanks, and have a great weekend.